almost anyone can buy a stock. You can buy it, and we've all got stories of someone who bought a stock and then it went up and then it went up some more and went up some more, and that's great. But you don't ever really hear about people selling. The art in any asset is not in the buying, it's in the selling. It's knowing when it's peaked and rolled over and going back down again. And it is very, very difficult to know. But let's just say from a hypothesis that you'll never be 100% certain when something's rolled over. No one rings the bell when the resource boom ended. No one's going to ring the bell when the interest rates have finished falling and go up. People just tend not to do that. But what you can do is put yourself in a frame of mind where you don't have to make enormous decisions, which is what we do. So when we think that something has rolled over, say we think the trend's ended and the stock seems to have rolled over, we sell 1/3 of the position. If that turns out to be right and it falls further, we feel kind of good about that because we've already sold 1/3. Then we sell another 1/3, and then we feel really good because we've sold 2/3, and if it falls further, we're delighted that we sold, and then we sell our third third. However, let's say we sell our first third and the stock starts going back up again. Then we buy back another 1% position. We don't kick ourselves. We don't get upset about it. We don't get emotional. We don't get uptight about having possibly made a wrong decision because we're not making enormous life-threatening decisions on a daily basis. I think for most investors, I really encourage that way of thinking. What I see most investors doing is actually putting too many of their eggs in one basket, in one position, then getting anxious about it, then getting stressed about it, then getting upset about it, then possibly making an incorrect decision, which they're most likely to do when they're in that frame of mind, and then getting more upset about it. And that is not the frame of mind you want to find yourself in when you're making decisions with money. It's really got to be quite a calm and relaxed process, so that if you're making a total decision about large parts of your portfolio on a daily basis or an hourly basis, that must be a very stressful world. That's not a world that we want to try and reproduce on a daily basis here. You get the two camps, the truly fundamental people and then the truly technical people, and we're not in either camp. We believe that using both skills gives you greater probability of outperforming than using one or the other alone. So a fundamental person can say coming into the global financial crisis that they think, for example, bank stocks are really cheap. For what they might think that. And then bank stocks drop to 1/5 of the price they were. And all the way down they're buying because they're fundamental. They're really deeply skewed in fundamentals and they don't care. And the only time they care is when they go bankrupt because they're buying stocks that are absolutely imploding. So, and their earnings may not have changed. The earnings, in actual fact, we've seen the bank shares, the earnings of, especially in Australia, the share price is halved, but the earnings growth just continued. So, in actual fact, if you say you're purely fundamental in that scenario, you would have lost a lot of money. Now, if you say you're purely technical and you never look at fundamentals, you would have been the very last person potentially buying internet stocks before the tech wreck. So when you're looking at things trading on 150 times revenue multiples with no prospect of earnings, whose future looked forward to really just bankruptcy, then you want to be very careful just trading the technicals. But it's a combination of the two where we think the real value lies. Where if you do find something really, really cheap, and you scale into it and let your profits run, then it can become something at a market multiple or even greater than a market multiple. And those are really the great stories of investment success. Things do get to 3 times cash flow. Gold stocks were at 3 times cash flow before the resources boom. Some of the financial stocks in Australia dropped to 3 and 4 times cash flow during the financial crisis and then recovered. And that's really when you're scaling into those positions and letting your profits run, you can make extraordinary amounts of money. And it kind of points to the second problem of finance, which is it's very difficult to know when to sell, but then at the very moment you should be buying when things are recovering, people psychologically are feeling scared and nervous and they don't want to do that, and that's really what you should be doing, and you should let your profits run. There's always that saying, man never went broke taking a profit. What no one says is no one really made a lot of money taking a small profit either. You've got to let your profits run to make really good returns.